We've talked about a proper investment strategy for your pension. And, today I found out that actually the base rates of the UK banking system are the lowest they've ever been since time began, or at least recording of what base rates were began. So this really sets the concern, sets the place for concern, because in unison with the base rate, you may have been reading about quantitative easing. Quantitative easing is the injection of money into the system, which is taking away from the people that want to retire and the insurance companies that want to buy the assets that create the income. It's taking away from them the choice. So what we're finding now is that what used to be a solution of an annuity, which when purchased at age 65, say with a fund of £100,000 just to keep things nice and easy, would have maybe created an income of £8,000 a year, today would only, for a married couple, providing an income for the spouse upon death, produce £6,000 a year. Now this is a huge reduction. And of course the other thing that goes with it, good for some, not so good for others, is that we're all living longer. So the expectation in the day that the pension first came about and the annuity as the solution at the end of a working lifetime was maybe 10 years of longevity. Today, that 10 years has now stretched to 30, 35, 40. We do have people living today of 100 years, 110 years of age. So you can imagine that if there isn't enough income from the pension pot to provide you with the quality of life that you want, it could be a long period of hardship, not something necessary to look forward to. So what we're talking about is pulling together a proper strategy for your money. And this is utilizing asset allocation, pulling together the theories of the past to enable us to utilize asset classes that don't all correlate and move in the same direction at the same time. This is something which is called modern portfolio theory and allows you to ensure that you're pulling together assets that are not only diversified, but are actually specifically pulled together to work in relation to your appetite for risk and appetite for investment loss. 7 years, we've been pulling together for our clients portfolios of diversified assets. We review these assets on a regular basis and ensure that where there is growth, that growth is redistributed amongst the portfolio to ensure that we don't get into a situation whereby we've got all of our eggs or more of our eggs in one particular basket. So balancing out the portfolio on a regular and consistent basis. By staying in touch with you, we're actually intimating to you that we are looking at and working with the fund managers in the marketplace to ensure that if a fund manager has moved from one investment house to another, or has retired, or has decided that they want to spend more time with their family, that we can actually move either with them if they've gone to a new investment house, or find another investment fund manager who is able to continue with the investment returns that we're looking for our clients' portfolios. So on a regular quarterly basis, we maintain touch with our clients, and this ensures that they're more comfortable. They understand the funds that they've got and are therefore more able to plan for what it is that they want in their retirement. Ultimately, we are working with our clients to help them create a better performance to provide them with greater income in their retirement. Over the years, many of our clients have told us that they have received their pension statement and filed it within 2 minutes. Well, filing something within 2 minutes is probably not going to give them the opportunity to review what the underlying investments are all about, and therefore have any real benefit to them in the long term. So that's the situation with one. But what we're finding is that several, and indeed many of our clients, have more than one pension statement that comes in. But the trouble is, that it doesn't come in on the same day as the others. So rather than having just one day to review, they may have 5 different pension statements that come in. They're all written in a different way. They've all got different numbers, different interpretations, different information. And unless you're familiar with all of the terminology, whether it's a with profits, whether there's a guaranteed annuity, whether you're in a fund which is a managed fund, or whether you're in a tracker fund, there's very, very little time. And without the focus and expertise that can be provided externally, to actually make sense of what is going on is the devil's own job. So by asking for the assistance of an expert, we can pull together all of the relevant information relating to the pensions that you have. This means that we're looking at the charging structure. It means we're looking at the funds, the performance of those funds, and can actually report that information back to you. So we can put information in front of you which is factual and therefore allow you to make decisions based upon fact. Now we come to the interactive part of this video. What I'm asking you to do today is to get hold of your pension statements. Have a look at them, shake them, take a look-see at what is actually on the second page. You may see that there are some charges in there. You may see that there are some illustrated numbers. Chances are those illustrated numbers will work along a real-time value and show you a number which actually could give you a bit of a shock, a bit of a start. But no matter, by pulling the information together, at least you've taken the first step to get control of what is an incredibly important time of your life. In our next video, when you've pulled together all of the information in relation to your pensions, I'll look forward to having the opportunity of going through with you what it is that you're looking for and what this information means to get you onto the first step to putting a proper investment strategy together for your retirement.